My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Financial Analytics as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 2 first important short question is Time value of money, TVM. Time value of money means that money you have today is worth more than the same amount in the future. This is because money can earn interest or be invested to grow over time. Imagine your friend offers you 1000 rupees now or 1000 rupee after 1 year. You should take it now because you can invest it and earn extra. Why time has value? You can earn interest. Inflation reduces future value. Money today gives you spending power now. Example. If you invest 1000 rupee today at 10% annual interest, after 1 year it becomes. Future value is equal to 1000 rupees times 1 plus 10% is equal to 1100 rupees. So, 1000 rupee today is worth 1100 rupees a year later. Easy tip to remember. TVM is equal to money now money later. Always consider the time value before saving, investing or borrowing money. Next important short question is 2. Future value and present value. Future value, FV, tells us how much money today will become in the future if invested at a certain interest rate. Example. You invest 1000 rupees at 10% interest for 1 year. FV is equal to 1000 rupees times 1 plus 10% is equal to 1100 rupees. So, 1000 rupee today becomes 1100 rupees in the future. Present value, PV, is the current worth of money you will get in the future after discounting it with interest. Example. You will get 1100 rupee after 1 year. If the interest rate is 10%. PV is equal to 1100 rupees, 1 plus 10% is equal to 1000 rupees. So, 1100 rupee after 1 year is worth 1000 rupee today. Easy tip to remember. Future value is equal to grow my money. Present value is equal to what's it worth today. Understanding FV and PV helps you compare investments, loans and savings plans smartly. Next important short question is 3. Simple interest, compound interest and annuity. Simple interest, C. Interest is calculated only on the original amount, principal. Formula, C is equal to P times R times T, 100. Example, 1000 rupees at 10% for 2 years. C is equal to 1000 times 10 times 2, 100 is equal to 200 rupees. Compound interest, CI. Interest is calculated on principal plus previous interest, interest on interest. Formula, CI is equal to P times 1 plus R slash 100 TT. Example, 1000 rupees at 10% for 2 years. CI is equal to 1000 times 1.1 to 1000 is equal to 210 rupees. Annuity. A series of equal payments made at regular intervals, monthly, yearly. Example, paying 1000 rupees every month into a savings plan is an annuity. It helps build wealth over time. Easy tip to remember. Simple is equal to same interest. Compound is equal to interest on interest. Annuity is equal to regular payments. These are key tools to understand how money grows over time. Next important short question is 4. Discounted and annuity. Discounted value. It means finding the present value of money you will get in the future using a discount rate, interest rate. Example. If you will receive 1,100 rupee after 1 year and the interest rate is 10%. Present, discounted, value is equal to 1,100 rupees, 1 plus 10% is equal to 1,000 rupees. So, 1,100 rupees in the future is worth 1,000 rupee today. Annuity. An annuity is a series of equal payments made at regular intervals, like monthly or yearly. Example. You deposit 1,000 rupees every month in a savings plan. That's an annuity. It helps you build wealth or repay loans. There are two types. Ordinary annuity payment at the end of each period. Annuity due payment at the beginning of each period. Easy tip to remember. Discounted is equal to future money's worth today. Annuity is equal to equal payments over time. Both are useful in planning loans, savings, and investments. Next important short question is 5. Arithmetic mean versus geometric mean. In risk and return, both arithmetic mean and geometric mean are used to calculate average returns, but they give different results. Arithmetic mean. This is the simple average of returns. Formula R plus R plus R plus plus Rn n. Example, if returns over 3 years are 10%, 12%, and 8%. Arithmetic mean is equal to 10 plus 12 plus 8, 3 is equal to 10%. Use when you want a quick estimate of returns, but it ignores compounding. Geometric mean. This considers compounding and gives the true average annual return over time. Formula 1 plus R times 1 plus R times 1 plus Rn 1 slash n 1. Example, returns is equal to plus 10%, 10%. Geometric mean is equal to 1.10 times 0.90, 1 is equal to 0.991, 0.5%. Even if the arithmetic average is 0%, actual return is negative. Easy tip to remember. Arithmetic is equal to simple but less accurate. Geometric is equal to real return with compounding. Use geometric mean for long-term investments. Next unit 2. Long questions. First important long question is 1. Equated loan amortization. Equated loan amortization means paying back a loan in equal installments, monthly or yearly, over a fixed period. Each installment, called EMI, equated monthly installment, includes both principal and interest. Think of it like a home loan or education loan where you pay a fixed amount every month until the loan is fully cleared. Why equal payments? Easy for budgeting. Helps borrower know the exact monthly amount. Lender gets interest plus regular principal repayment. Formula for EMI, monthly installment. EMI is equal to P times R times 1 plus R n 1 plus R n 1. Where P is equal to loan amount, principal. R is equal to monthly interest rate, annual rate divided by 12 divided by 100. N is equal to total number of months. Example. Loan is equal to 1 lakh rupees. Interest is equal to 12% annually is equal to 1% monthly. Term is equal to 12 months. EMI is equal to 1, 0.000 times 0.01 times 1.01, 12, 1.01, 12, 8,885 rupees. You'll pay 8,885 rupees every month for 12 months. Each EMI includes A part that goes toward interest. A part that reduces the principal. As months go by, the interest part decreases and principal part increases. This is called amortization schedule. Easy tip to remember. EMI is equal to equal payments. Amortization is equal to splitting loan into monthly parts. Start more interest, less principal. End more principal, less interest. This method is widely used in home loans, car loans, and personal loans. Understanding it helps you plan your finances better and avoid debt traps. Next important long question is 2. Risk and return, holding period return, HPR. Holding period return, HPR, is the total return earned by an investor from holding an investment over a certain period. It includes capital gains or losses, change in price, plus any income received, such as dividends or interest. Why is HPR important? It tells you how much profit or loss you made on your investment during the time you held it. This helps in comparing investments with different holding periods. How to calculate HPR? HPR is equal to selling price purchase price plus income purchase price times 100. Selling price when you sell the asset. Purchase price when you bought it. Income, dividends or interest earned during holding. Example. Suppose you bought shares for 1000 rupees. After 1 year, you sell them for 1200 rupees and received 50 rupees as dividends during the year. HPR is equal to 25%. You earned a 25% return during the holding period. Remember, HPR shows total return but does not consider the length of time. To compare investments over different time periods, use annualized return or geometric mean. Easy tip to remember. Holding period return is equal to price gain plus income divided by original price times 100. It tells you how well your investment did during the time you owned it, a simple way to measure profit or loss. Knowing HPR helps you make smarter decisions about buying, selling, or holding investments. Next important long question is 3. Risk standard deviation. Standard deviation is a popular way to measure risk in investments. It tells us how much the returns of an investment vary or fluctuate from the average return. What does it mean? A low standard deviation means returns are close to the average, less risky and more predictable. A high standard deviation means returns are spread out over a wide range, more risky and uncertain. Why is it important? Investors want to know the consistency of their returns. Two investments might have the same average return, but one may be much riskier because its returns jump up and down more. How to calculate? Simple idea. 1. Find the average return over a period, mean. 2. Calculate the difference between each return and the average. 3. Square these differences to avoid negatives. 4. Find the average of the squared differences, variance. 5. Take the square root of the variance. This is the standard deviation. Example. Imagine a stock gave returns of 10%, 12%, and 8% over 3 years. The average is 10%. Differences from average, 0%, plus 2%, minus 2%. Squares, 0 superscript 2 is equal to 0, 2 superscript 2 is equal to 4, minus 2, superscript 2 is equal to 4. Average squared difference, variance, is equal to 0 plus 4 plus 4, 3 is equal to 2.67. Standard deviation is equal to 2.67, 1.63%. So, The returns usually vary plus or minus 1.63% around the average 10%. Easy tip to remember. Standard deviation is equal to how spread out your returns are. Small SD is equal to stable, less risky. Large SD is equal to unpredictable, more risky. Investors use standard deviation to decide if the potential reward is worth the risk. Always balance return and risk for smart investing. Next important long question is 4. Coefficient of variation, CV. Coefficient of variation, CV, is a useful way to measure risk relative to return. It tells you how much risk you are taking for each unit of return. What is CV? CV is the ratio of standard deviation, risk, to the average return. It helps compare the riskiness of different investments, even if their returns are very different. Why use CV? Two investments may have the same risk, standard deviation, but different returns. CV shows which investment is better by showing risk per unit of return. Formula. CV is equal to standard deviation average return. Example. Investment A. Average return is equal to 12%. Standard deviation is equal to 6%. Investment B. Average return is equal to 8%. Standard deviation is equal to 4%. Calculate CV for both. CV A is equal to 612 is equal to 0.5. CV B is equal to 48 is equal to 0.5. Both have the same CV, 0.5, meaning they carry equal risk per unit of return. Interpretation. Lower CV means less risk per unit of return, better investment. Higher CV means more risk for each unit of return. Easy tip to remember. CV is equal to risk divided by return. Helps you choose the best investment by balancing risk and reward. Useful when comparing investments with different returns. Summary. If you want to invest wisely, don't look at returns alone. Check the coefficient of variation to see how much risk you are taking for that return. Lower CV means safer and smarter investment. Next important long question is 5. Beta. Beta is a measure of an investment's risk compared to the overall market. It tells you how much the price of a stock or portfolio moves compared to the market index, like the Nifty or Sensex. What does beta mean? Beta is equal to 1, stock moves exactly like the market. If market goes up 5%, stock likely goes up 5%. Beta 1, stock is more volatile than the market. If beta is equal to 1.5, stock can move 1.5 times the market. So if market rises 5%, stock may rise 7.5%, 5 times 1.5, but it can also fall more. Beta 1, stock is less volatile than the market. If beta is equal to 0.7, stock moves 70% as much as market. Beta 0, rare, means stock moves opposite to market, very unusual. Why is beta important? Investors use beta to understand how risky a stock is compared to the whole market. Higher beta stocks can give bigger gains, but also bigger losses. Low beta stocks are safer but with smaller returns. Example. Suppose the Sensex goes up 10%. Stock A has beta is equal to 1. 2 likely goes up 12%, 1.2 by 10%. Stock B has beta is equal to 0.8 likely goes up 8%, 0.8 by 10%. Stock C has beta is equal to 1 moves with market 10%. Easy tip to remember. Beta shows stocks market sensitivity. Beta 1 is equal to high risk, high reward. Beta 1 is equal to low risk, stable. Use beta to match your risk appetite with your investment choice. Summary. If you want big returns and can take risks, look for high beta stocks. If you prefer safety, pick low beta stocks. Beta helps you understand the market-related risk of your investments easily.